This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody, welcome to Bloomberg Businessweek Daily. We are across radio, TV, YouTube, Bloomberg Originals. Massar, Tim Stenovec, live here at Bloomberg headquarters in New York City. We have seen equities over the last hour or so take a leg down to its lows of the session in terms of those major equity averages. We're bouncing off of it, but I was just pulling up a story out from the AP just about 1:58 p.m. President Trump ordering the U.S. military to, quote, shoot and kill Iranian small boats choking the Strait of Hormuz. Safe to say it felt like we were treading water a little bit earlier in the trading session, but the standoff in the Strait of Hormuz creating investor concerns, and I think safe to say global concerns about where we are in this war between the United States and Iran and Israel.
Yeah, we really saw stocks take a leg lower after the Iran newswire reported that active air defense systems were engaging in hostile targets over Tehran. That jolted a market that had leaned heavily into this idea of fragile optimism. Like the status quo, there was a ceasefire that the president's staff clarified yesterday was not 3 to 5 days, but instead was until they got a deal done.
Yeah, exactly. So, all right, the back and forth continues. We're going to keep an eye on it. We did see, I think, oil also spike. Let me just pull up WTI crude futures on my Bloomberg, 3.4% to the upside. We've been as high as 5.8%. So definitely trending higher, though, overall in the session. We're going to get an update on the trade in a moment. We're also going to talk big time tech, a deep dive with our own Ed Ludlow. We've got Meta headlines that crossed just a little while ago, in fact, about cutting 10% of jobs. So we'll talk about that. We've got Tesla, which rallied after hours yesterday, and then it didn't, especially when the company mentioned its CapEx spending.
Yeah, that wasn't in the earnings statement. Instead, that came on the call.
Not in the deck?
That moved the company's stock. We got Ed on that in just a minute. Also, another group that soared yesterday, only to drop back today, cannabis companies. It was a classic buy on the rumor, sell on the news situation. The CEO of Curaleaf is stopping by in just a few moments.
Yeah, we've also got the head of macro over at Lombard, Odier Investment, Florian Ielpo. He's going to be back with us, kind of tying it all together. And then we get another read on the economy with the real estate services firm, CBRE. We've got the CEO actually talking to our Norah Mulinda. We're talking about Bob Sulentic. So a lot coming your way in the next 60 minutes.
First up, though, let's get a check on the trading day and the weakness that we're seeing across stocks, the strength that we're seeing when it comes to energy. Charlie Pellet is standing by in the Bloomberg newsroom. Hey, Charlie.
Thank you very much, Tim and Carol. And in a sentence here, we have got oil pushing higher, S&P, Dow, NASDAQ, all declining. We are, however, off our session lows. Let's get right to the numbers here. We got fast-moving markets on this Thursday here with the S&P 500 index now at 7,095. We are down 43 again, off session lows, down now by about 0.6%. Dow Industrials down 309, drop there of 0.6%. NASDAQ is down 1%. The NASDAQ 100 index down 0.6%. All of this with the VIX just below 20, the 10-year, 4.31%. With a 2-year currently yielding 3.81%. Now gold down 0.5%, 47.15 the ounce, while West Texas Intermediate crude oil WTI is up 3%, 95.73 a barrel. Brent holding above $104 a barrel, up by 2.5%. Lots of tech news today, specifically job cuts. Meta Platforms plans to cut 10% of its workers in an effort to boost efficiency and offset its heavy spending on AI. Meta right now down by 2.4%, and Microsoft offering voluntary retirement to thousands of its employees in the United States. Microsoft now down by 4.1%. So again, recapping here, the Dow, the S&P, NASDAQ very much in the red. Key takeaway at this hour, we're off session lows, but still down by 0.6%. Keeping an eye on crude. WTI just below $96 a barrel, up by 3.1%. Tim and Carol, that is a Bloomberg Business Flash.
All right, folks, and we're going to keep an eye on those headlines. I mentioned the President Trump about shooting and killing Iranian small boats. That actually came out in a tweet earlier this morning. But it's the back and forth in the Strait that is ultimately certainly putting pressure on global financial markets, because it doesn't seem like a step closer to peace talks. In fact, it feels like a step closer to escalation. But who knows what's going on behind closed doors. All right, we'll keep a watch on it for you. Charlie, thank you so much. Meantime, we're also watching big time the tech sector. Meta Platforms planning to cut 10% of workers, or roughly 8,000 employees, in an effort to boost efficiency and offset its heavy spending on artificial intelligence. Now, the company disclosed the move in a memo sent to employees today, saying the layoffs will come on May 20th. Meta also will not hire workers for 6,000 open roles that it had intended to fill. Ed Ludlow is with us, covering everything that's going on in the tech sector, including Meta. He's co-host of Bloomberg Tech on Bloomberg TV, 11 to 12 noon every Monday through Friday. He joins us here in our studio.
For him, it's earlier when he does this.
I know, but
that's okay.
I'm living on East Coast time.
And I'm here with you. I'm here for it.
And it's been full time for you. You have been doing double, triple duty. Let's talk about Meta.
Yeah.
Good news, bad news. What's the read?
Well, just in the moment when the headlines hit, the stock was already down 2.5%, and there was a big, basically algo spike, and it paired declines, and it's back where it was. Right? It probably is a sell the news kind of moment. There had been reports that about 8,000 was what they were looking at, and there's always another side of the story. And so for Meta, the other side of the story is capital expenditures and its commitment to spend into AI. And it was really interesting. I was just on Balance of Power when the story broke. Think about it not just as like a capital expenditure figure for 1 year, but Mark Zuckerberg sitting next to President Trump at that dinner last year saying, oh, well, Mr. President, I'm going to spend $600 billion in this country over the next 3 years.
And then later, what did he say in the president's ear that was picked up on the mic?
Yeah.
I wasn't actually expecting to say that.
And he's not alone. They kind of went around the table, right?
Yeah.
But that's the story. And so, if you're going to commit to spend on physical things, infrastructure, something's got to give, and it's on headcount where they focus that.
Is that what is more physical infrastructure than those incredibly expensive poaches that they made when it comes to AI, those $10, $20, $30 million salaries we're talking about?
One thing I would say, I'm not an accountant, nor am I a forensic accounting journalist, but remember that stock comp comes into play big time. Mm-hmm. So what Tim's talking about is Meta hired really competitively to build the superintelligence team. And part of that, we're talking about pay packages that are in the hundreds of millions of dollars, which sounds crazy when you say it out loud. A lot of that is related to stock-based compensation. Yes, we're talking about physical things. Meta is not a cloud computing company, but it is at hyperscale in that it operates its own data centers, and it is heavily committed to buying the latest chips and building more of them to train AI models and then run AI workloads.
I mean, at this point, you are judged, it feels like, as certainly a hyperscaler, one of these big tech companies, that you are all in doing the right things with AI. That seems to be the play that everybody wants to see you doing. We'll see what the payoff is ultimately, right? But at some point, too, as a publicly held entity, Meta, Mark Zuckerberg, they've got to manage costs.
Well, you're also damned if you do, damned if you don't.
Yes.
So Meta is down right now. It has just, Bloomberg's reported, sent a memo to all its staff saying it's cutting 10% of jobs. And Bloomberg's headline is, in push for efficiency. I remember 2023 when Mark Zuckerberg declared the year of efficiency.
Yeah.
And the story then was Wall Street punishing Meta or Facebook for all the cash it was burning through in its Reality Labs division. They were saying, stop losing money and do things more profitably and efficiently across the business in aggregate. It's kind of a similar story now where the market's like, we want you to spend a lot on AI, but we don't want you to do it irresponsibly,
Yeah, but they've given up completely on the metaverse, I think it's fair to say.
So the metaverse, I mean, we don't have enough time to get into the history of the metaverse, but basically through virtual and augmented reality headsets, the metaverse was a digital world we were all going to hang out in, and that's not a priority anymore.
No, but hey, I do want to touch on it's related to Meta's identity. As a company, and this is a company known for WhatsApp, Facebook, the Blue app, and of course Instagram and more. Yeah, but it's an advertising company.
Yes,
and that's where it makes money. So, and that's where it still makes money.
Yes,
is that what the AI investments are about? Is it getting the ads that show up in my Instagram feed that much more targeted to me and
Super
that much
smart
better?
question. I mean, what most people probably underappreciate is that a lot of the work Meta is doing in AI is for its own internal use. Yeah. So, for example, we did a big story a few weeks ago on its in-house chips. They are called the MTIA program, Meta Training Inference Accelerators. One of the uses of those is to train the algorithm that decides where an ad places specific to you in your timeline. Now that impacts how much money they make from you as a user. So like that's an example. Also important to note that like internally there are loads of different teams, right? They all fight each other for compute because they will say, look at the project I'm doing. I need access to the servers to run my AI. And another team would argue the same. That's a big part of this story. They're not selling that AI to the general population.
Big difference from some of the other companies that are out there.
Well, quite. You know, if you accept that Meta is a developer of leading AI models, OpenAI is another leading developer of AI models. It sells that model either through a subscription or through an enterprise agreement. We call it ChatGPT, but there are other, more enterprise-specific variants and access points than that. Meta doesn't do that. It still makes bread and butter from ads. Yeah.
But you hate to be that employee who has to go because you're not part of the efficiency. I'm just saying.
Yeah.
Like, there's people
and
involved.
That's 1 out of 10.
Yeah.
We only have a little bit of time, like 30 seconds for Tesla. That's where we were planning to start with you before the Meta news.
No worries.
Shares down 3.5%, 20 billion to 25 billion. That's why.
Tesla's going to spend
$5 billion?
No, $25 billion in CapEx is a monster number for Tesla.
But it was 20. What's $5 billion more?
Because they got to spend even more, spend money to prove they're actually doing the AI projects, Robotaxi and Optimus. That's as simple as that.
You called it. You said when we talked.
Yeah.
As the earnings came out, you're like, I want to know what's it going to do the robots, to do all of this stuff. It's expensive, the build out.
Yeah, it wasn't in the deck. It was only on the call.
Deck.
And so Elon's warning very quick is expect this to last for many years and a multi-year investment cycle, spend money, burn cash.
Is he right?
AI.
You got to spend, right, to make money.
Yes.
It just depends if it's going to be too much and whether or not the money comes back. All right. Ed Ludlow, thank you so much. We really don't want you to go back to the West Coast. But
no, he's going to come back here before he goes back to the West Coast. 4 o'clock.
We've got more with you.
Yes,
it's on your calendar.
I believe so. Yeah.
Okay, it's on your calendar.
We're actually going to we're going to talk Intel. We're going to talk a deep dive into the business of space. So I'm not going to say goodbye. Not yet.
No, see you later.
All right. Let's get a read on the markets that we earlier seemed to be treading water, but now we know we've got a lot more pressure. Right now you've got 34 points lower on the S&P, down about 0.5%, down 0.5%, 150 points to the downside on the NASDAQ 100. We have come off well off our lows here, but we know what's going on here.
Yeah, we want to bring in the head of macro at the active investment manager operating across Europe, Asia, and North America, Lombard Odier Investment. Florian Ielpo back with us, joining us today from Geneva, where it's late into the evening after 8 o'clock, so we appreciate you taking the time. Florian, the headline that we got that moved markets here in the U.S. and moved oil too was about Tehran activating its defense systems and explosions being heard. This is coming from Tehran, we should note, and from Newswire in Tehran. But I'm curious from you about the macroeconomic backdrop of a war that doesn't seem to where the ceasefire is holding, at least right now.
True. Hi, Tim. I'm Carol. Thanks for having me again. I think it's important to start from the big disagreement, which we can see from market at the moment. The oil market is saying risk when the equity market is saying risk on and go with the flow. So there's this disagreement going on. The crisis we're confronted in the Strait of Hormuz has this particularity that the longer it lasts, the higher the leverage, basically, Iran have on the US, and that leverage is called inflation, meaning it's not war itself, it's just a negative impact of this overall situation. So our own estimates are very simple. What they're saying is that if you stay where we are at the moment for a period of 3 months, you're supposed to be eating about, let's say, 5 to 15% of your earnings growth, which is not huge, but still significant enough to let investors rethink their exposure to the market at this point in time in the here and now.
Say that again. You said eating 5% of what? I'm sorry, just if you could reiterate that.
No worries. 5 to 10% of earnings growth, which is pretty much what's animating market at the moment, right? It was all about the earnings season until now. And this earnings season was coming with the good news of expanding earnings, a strong earnings growth. And that was the best moment for the stock market to rally on the back of that. Now, well, basically, we're still confronted with the temptation of taking profit because this inflation shock creates potentially a negative earnings shock.
You know, Florian, something we talked about yesterday.
I'm so glad you're going there.
Right, this new normal that our team wrote about, Bloomberg Economics, but basically no peace, no war. The new normal in the relationship between the United States and Iran. Is that what we're moving towards in your view? And is that going to be stable enough for investors, for CEOs, for heads of institutions and organizations to make decisions and move forward, and for global economic growth?
It's a very broad question. I'm going to answer from the investment perspective, basically. I think this new normal makes a very strong difference between stocks which have a business model which is cyclical and stocks which have a business model which will monetize in a few years with, a longer term investment horizon. Of course, when I'm saying that, I'm opposing value to growth. I'm opposing Europe to US, essentially, and with the emerging world in the midst, in the middle of the situation. So this new status quo basically is a call for investors to rethink the way they access equity market, and maybe growth is exactly the place where you want to be at this point in time, because growth is a kind of style that looks through short to medium term issues, which is pretty much what we're confronted with.
But growth everywhere, or just growth in the US? Because one thing that we have spent a lot of time talking about is the different way this energy shock is being dealt with by US companies versus by companies in Asia, for example, by companies in Europe, for example. So what's your view there?
Intuitive call, of course, is diversify. The one thing I would look at is what's called PEG, so the price earning to earnings growth ratio, so that to assess whether the valuation of your stocks is still outpaced by the growth rate of your earnings. And that's pretty much what's happening in the US at the moment. That's why the S&P these days is on a roll, because basically the earnings growth we're getting from this Q1 season is showing such a growth rate, a surprisingly high growth rate, that it outpaces the expensiveness of the overall index. That expensiveness is weaker in the emerging world, but still attractive. So let's say a combination between the two is potentially one way to say through those waters.
So, Florian, the AI revolution is a revolution in your view that needs to be treated as such. And I'm curious those are your words, what that means. What do you mean treated? And I do also wonder, does that revolution continue even if this war continues, or some kind of uneasy stalemate continues between the US and Iran?
Of course, we're confronted with the technical revolution. And we've been there before. Simply the one technological revolutions we've seen in the past have come with a slow adoption rate until the internet revolution. So basically, if you go back into the 19th century and you look at the performance of US equities during the railway building, the electrification of the United States, the decades of that change was actually coming with negative stock returns, which is not good news, right? Actually, like a century ago, investors were fearing technological change. Now we're embracing it. And the difference between these two situations is adoption. The adoption rate of the current revolution is actually quite fast. It's quite fast for a reason, because let's say our demography calls for that change. We have a slowing growth of our population globally. And that slowing growth is actually one of the remedies, is the tech change we're currently experiencing.
All I hope is that artificial intelligence does shopping, because my understanding is the consumer is pretty important to certainly the U.S. economy. All right, we got to leave it there. Florian, thank you so much. Florian Ielpo, he's the head of macro at Lombard, Odier Investment. I think about that.
Yeah.
Does AI shop?
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ, all very much in the red. We are, however, off session lows. Now, you got to keep in mind that moments ago we did have the S&P down as much as 91 points, down now by 33. Have been down as much as 1.3%. Right now, that is down to a 0.5% loss on the S&P. Dow Industrials down 0.4%, lower by 220. NASDAQ Composite Index down 232 for NASDAQ, a drop right now of just about 0.9%. All of this with the VIX at 19, the 10-year 4.31%, 2-year yield 3.81%. Spot gold is down 0.6%, 47.12 the ounce, while West Texas Intermediate crude oil up 3.2%, 95.84 a barrel. A flare-up in tensions over the Strait of Hormuz has sent stocks lower. Oil is rising on concern that a prolonged closure of the waterway could worsen energy disruptions. Briefly, sources tell Bloomberg Microsoft is offering voluntary retirement to thousands of its employees in the U.S. Meta Platforms, meanwhile, telling staff it will be cutting 10% of jobs in a push for efficiency. Recapping, Dow, S&P, NASDAQ, all very much in the red. Right now, we got the S&P down by 0.5%. I'm Charlie Pellet. Carol and Tim, that is a Bloomberg Business Flash.
Appreciate that. Charlie Pellet there. Well, we're watching two different sectors today. We're going to get to real estate in just a moment, but we're also keeping a close watch on cannabis stocks. Advisor Shares Plus U.S. Cannabis ETF, Amplify Alternative Harvest ETF, Tilray, Aurora Cannabis, Kronos, Canopy Growth, Curaleaf Holdings. I mean, these are on our radar. Shares of these cannabis companies and ETFs, some getting a bit of a reset, dropping back today after soaring in yesterday's session, and that was on expectations that the Justice Department and DEA would move certain marijuana products to the less strictly controlled Schedule 3, which is reserved for drugs with accepted medical uses and lower abuse potential. Well, that happened, Tim, earlier today.
We're here to talk about the move and what, if anything, it changes for these companies. We've got the CEO, chairman, and co-founder of one of them. Boris Johnson is joining us. He is chairman, CEO, and co-founder of Curaleaf Holdings. He joins us from Europe. Boris, good to have you on the program. So what does it mean that the Justice Department and DEA removes certain marijuana products or moves them to the less strictly controlled Schedule 3? What does that do for your company?
Well, Tim, first I want to correct. I'm not Boris Johnson. Boris Jordan.
Boris Jordan. Excuse me.
A much more important person.
I apologize. Thank you for that, Boris Jordan. Good to see you.
But, no problem, Tim. Listen, this is a monumental move. It's been 55 years since President Nixon, on a political decision, scheduled cannabis as a Schedule I drug. It's a product that was used for hundreds and hundreds of years as a wellness product by many, both in Europe and the United States. It wasn't too long that Eli Lilly and other pharmaceutical companies were selling cannabis extracts for medical reasons. So this reclassifies it from a Schedule I to a Schedule III drug. It has several major impacts. The first impact, of course, is that we will be allowed to do research, working with medical institutions and get federal grants to do that research on the product nationwide. Curaleaf, as the largest operator globally and working in Europe, just finished phase 1 trials on neuropathic medication with cannabis in Europe, in London, in the UK, and moving on to phase 2. We can now bring that to the United States. We couldn't do any of that work in the United States. We have a partnership with the University of Pennsylvania Medical Center, and so we will start doing that work here in the United States. The second aspect of it is that we had a capricious tax on basically a revenue tax on gross margin, which was about 72%. That, it was almost impossibly be a profitable company on that basis. Now that will go away as well. So we'll be taxed and treated as any other corporation in the United States, which will immediately make most of the larger players like Curaleaf very profitable going forward.
All right. So is the job done? Is this all you guys need to kind of move forward?
No, I think that the current rescheduling is being done in 2 steps. The first step was under something called the United Nations Single Convention on Narcotics. That was the first step for medical, because under the UN treaty, you can only reschedule for medical reasons. The second will be a ALJ hearing, was a process started under President Biden, which was halted at the beginning of the Trump presidency, and that will now be restarted on June 29th. That will address the issue of adult use cannabis, rescheduling those products as well. Once that happens, what we expect to happen in the third quarter, then for the most part, I would say this was the first step. Now we need to start working with the federal government on banking, on uplisting to major exchanges in the United States.
Okay.
And so there'll be a lot more work to be done.
So that's what I want to talk to you about, is the banking side of this and what it changes for banks that are, if anything, does it change anything for banks? Or is the next step that there is something from the federal government that allows banks to do business in this industry?
So using the proverbial, broke the glass ceiling, this breaks the glass ceiling.
Okay.
This is the first piece of federal legislation that we've seen since 20 years ago when Rohrabacher-Farr was passed, protecting medical cannabis companies in the states. Now you have the rescheduling of cannabis. I believe that you're going to see action from the Treasury. We know that both Janet Yellen and I believe Scott Bessent have both said they want major banking institutions to bank the cannabis sector. They also want to see these companies on U.S. exchanges. And that will be a part of the process. That may need some legislation from Congress, but also because of the fact that we will be applying for DEA licenses, that will make us federally legal as medical companies now. That will most likely give us the ability to at least apply for uplisting on the U.S. exchanges.
Hey.
Credit cards, I think, are going to be a big deal, which will increase business dramatically. So all of these things, I think, are on the horizon going forward.
Hey, Boris, but at the end of the day, if the Democrats take the House in November, do you think a future Congress can get along with President Trump to bring recreational changes?
I think that we're not going to see a lot of recreational changes. I think the next step is going to be the whole financial services aspect of the business. So we've now rescheduled, and now we'll see recreational. I believe that get to legalize this recreationally nationally at a federal level, we need to do the work, right? That's why they're rescheduling from Schedule 1 to Schedule 3. We need to do the work with the medical institutions in the countries to work on all of the aspects of the plant, to make sure the plant is safe. We know it's safe, but we need to have evidence now, because in Europe it's been proven, in Israel and other places, that this is a plant that has a lot of wellness aspects to it. We now need to do that in the United States. I think that will take 2 to 3 years. So I more than likely suspect that full legalization will probably happen in the next administration. Not that Trump doesn't want to do it, but I believe just the steps that need to be taken are going to take 2 to 3 more years.
Who's ever in the White House, who's ever in Congress in the next administration, you think it'll still go through?
Yes, I think we're past the point where cannabis was, stigmatized the way it was. The Democrats, as we know, this polls at almost 80% in the country for legalization. Amongst Republicans, it's 59, 60%. Amongst the whole country, it's almost 80%. So I pretty much feel that this is going to happen, but it'll probably happen in 2 to 3 years on full legalization. But this is a major step forward.
Boris, you mentioned the idea of moving from stock exchanges outside of the United States to the United States. Would you do that at Curaleaf?
Yeah, Curaleaf today is the only major cannabis company, global cannabis company, that trades on the TSX in Canada, which is a major exchange in Canada, but still we don't trade on the NASDAQ. I do believe that this will, over the next couple of years, will more than likely allow us to uplist to U.S. exchanges.
Hey, what do you think happens in terms of the industry? So many times you start to see some consolidation of, very smaller companies tying up together. Do you think that ultimately this is going to spur M&A activity? The idea being that if more companies are getting the 280E tax relief, does it make it more attractive, Boris, for the larger players to come in and buy up some of those smaller companies?
Absolutely. I think you're going to see a tremendous amount of consolidation going in the second half of 26 and 27. This decision brings down the cost of capital. It will increase capitalizations, even though we're seeing a correction today. I think it's a misunderstanding of the whole process. People are trying to digest it. But I do think it's going to widen the investor pool that can invest in the sector. I think you're going to see more and more money coming into it, a reevaluation of these companies. And on the back of that, you are going to see consolidation. This is a scale business. We need to consolidate these companies and create scale.
What does it mean for Curaleaf? So are you already taking calls, thinking about strategizing, like who you might want to tie up with?
I mean, Curaleaf's already the largest global player. We are definitely going to be acting on that consolidation. We are in talks with numerous, both regional as well as larger companies. We are talks in Europe. We're talks in the United States. We've been having them for a while because we knew this was coming. It was just a matter of when it was going to come. It has now happened. I think it creates certainty in the market from a balance sheet and cash flow perspective for these companies. So now I think it'll be a lot easier to make these transactions happen.
All right. Stock was up 26% yesterday. It's down about 22% today. Is it just a case that this is going to still take time?
I think, yes. You have to understand that the cannabis sector today does not have virtually no institutional money. This is largely algorithms and retail investors trading in and out of these stocks. as we start to see large institutional investors come back into the sector, those that were there, for instance, when Curaleaf went public in 2018, we had BlackRock, we had Fidelity, we had all of these players in the IPO. Then they all had to exit because Jeff Sessions removed the Cole memo, which made it uncertain to invest in the sector. As those investors reacquaint on the back of this decision with the sector and they get permission to invest, I think you're going to see a dramatic reevaluation in these stocks. I think this is a massive buying opportunity. And if we weren't in the middle of a blackout period, I can tell you we have a buyback program, we would be doing it.
Okay, well, you got to come back when you're not in the middle of the blackout. Speaking of buying, Boris Jordan, I want to go back to what you said about M&A and the discussions that you're having with companies all over the world and here in the United States too. Push deeper for us with that, and like what kind of companies? I know you probably can't say the names of the companies, but like what specific types of company is attractive to you right now?
I think, given the current regulation, I think we're looking at both retail, which is very unusual right now. We're looking at retail. 65% of our business is sold online. However, we still have to deliver the product from our delivery point. So think about Amazon and Whole Foods, very similar model where they both come into the store, but mainly come in just to pick up what they bought online. And about 30% will actually buy in the store. So we're looking for retail distribution points to continue to distribute these products throughout the country. So we're looking at tuck-in acquisitions in the various states around the country now. And also we're looking at large-scale companies because a lot of these companies, because of historic state regulations, couldn't combine because they had limitations. Most of those limitations are gone now. And the scale, we want to build scale and get cost savings from that scale. And we can do that today because the transactions couldn't happen till this day because there was too much uncertainty around the balance sheets because of the tax accruals. Now that uncertainty has gone away, now that these companies will be largely significantly cash flow positive and profitable, it makes it much easier to do the transactions.
All right, good stuff. As always, really great to check in with you once again. Boris Jordan, not Boris Johnson. Boris Jordan.
Thanks for reminding me. Thanks for that.
I can laugh.
Although he was a prime minister of England, so I don't.
And mayor of London, yes.
It's a good comparison.
And mayor of London, and the head of the Spectator, editor-in-chief. So.
Yes, people forget about his journalist past. But Boris Jordan, we'll never forget about you.
That voice you're hearing is Boris Jordan. He's Chairman, CEO, and co-founder of the $2.4 billion market cap company Curaleaf Holdings. All right, let's get to another sector on our radar.
And that is commercial real estate. The more than $42 billion real estate services provider, CBRE Group, reported its quarterly results this morning. The company's revenue for their first quarter beat the average analyst estimate, boosted its core earnings forecast for the full year. Bloomberg TV Markets correspondent Norah Mulinda caught up today with the chairman and CEO of CBRE, Bob Sulentic.
We have about $155 billion of assets under management. We access considerable capital from the Middle East. We've downgraded our capital raising goals for the year by only less than 10% as a result of what's going on, because what we're already seeing is the capital sources in the Middle East regrouping and putting new plans in place to invest in the United States and other parts of the world. So that's going to have a little impact on our business, not much.
What do you expect that to be?
Less than 10%.
Okay.
Yeah, less. And by the way, we haven't really downgraded our expectations for earnings in that business, just some of the capital raising in that part of the business. If you look at the rest of our business, there's no part of the rest of our business where we earn as much as 5% of our profits, so it's not a real concern. Of course, what is a concern to all of us, real estate, critical infrastructure, data centers aside, is if what goes on there results in prices for energy going up to the point where we might have a recession, then of course we all got to pay attention to that.
Well, coming back to the U.S., I also want to talk about the tax environment. We know big cities like New York City have really been in focus. Are you at all seeing any particular business shift toward lower tax, faster growing markets like the Sun Belt, in particular with your business?
You know, our business, as you probably would expect in Texas and Florida, is quite strong in both those markets. We've seen a lot. Texas, we've seen tremendous growth. We've seen also considerable growth in Florida, and I think some of that is tax driven. But our biggest profit market in the world is the one we're sitting in here today, New York City. And we had a spectacular first quarter in New York City.
So you're not expecting any particular pullback or potential bearishness when people think about the New York City tax environment?
We aren't. I'll tell you one thing we talk about all the time is we have also a very big business in London and a very big business in Tokyo. And over the last couple decades, there's been the coming and going about, is London dead? Is New York dead? Is it dying? Is Tokyo dying? All three of those markets are so big and so diverse and such a magnet for people and companies and so forth. They're all doing extremely well now, and we're bullish about the long-term prospects for New York and the others as well.
Well, speaking about the long-term outlook as we wrap, I want to understand, what are you optimistic about over the next 12, maybe 18 months, and what potentially keeps you up at night?
Yeah. I'm generally optimistic about our business in a broad-based sense.
And that is Bloomberg TV Markets correspondent Norah Mulinda, who is here around the table with us in the studio. She, of course, caught up, as you saw and heard, with the chairman and CEO of CBRE, Bob Sulentic. Hey, Norah, good to have you here. Real estate, as you know, so sensitive to rate, interest rate, and economic cycles. In general, they are a real estate servicing company. When you sat down to talk to them, what was it that you wanted to kind of really get to?
Well, as you mentioned, they are a real estate services company, so they made it pretty clear that they don't like to necessarily be classified with the REITs, which we know tend to pay dividends. This is not necessarily a dividend-paying business when you think about CBRE. Also, CBRE tends to be known as a brokerage company, but they've really been, I'll say, maybe de-emphasizing that aspect of the business in terms of its exposure, and they really are leaning a lot more into critical infrastructure, leaning into data centers. If you flash back to 2021, they only had about 3% of their profit was focused on critical infrastructure and data centers. Now it's up at 14% as of 2025. So you're really seeing them trying to lean into that specifically. And we did get to catch up, of course, as to what's been going on in the headlines, Middle East, also what's going on here in New York.
Yeah, let's talk about the Middle East a little bit, and then we'll get to New York. In terms of the Middle East, what is the company's exposure to that part of the world when it comes to when it comes to it, not just its assets, but where the revenue comes from?
Right, and that's what I really wanted to get to, because they do have exposure in the Middle East, Abu Dhabi, other areas in the region, and we do know, given the fact that we're in the situation with the conflict in the Middle East, that's something I'd like to know in terms of whether or not investors are potentially wanting to stay more domestic, as opposed to doing some of that cross-border different agreements and partnerships. He essentially said that they downgraded their capital raising goals by less than 10%. He doesn't really see it to be a large impact on their business in the Middle East. Seems as though it's overwhelmingly stable. That's what I took away from that conversation with him.
Okay.
Yeah, what about deal making and capital flows? It's always interesting to see in different rate environments and market cycles what they're seeing along those lines.
Absolutely. I mean, we talked a lot about New York City. He talked about this being actually
not running away.
Right, not running away, actually leaning in. He talked about the fact that when you look at their metrics, New York City, the infrastructure here actually accounted for a lot of their gains in the last quarter. So we've heard this story over and over again about the flight from New York City, the flight from San Francisco, all these big cities. You know, London is dead, Tokyo is dead, New York City's dead, is what he was saying. Mm-hmm. And he's saying that actually, if you look at the fundamentals, if you look at their stats, it's actually a lot better here in New York City than what's actually being painted broad-based across the industry.
I mean, I like the sound of that, but
yeah.
But is there, does he have the evidence to back that up right now? Because what we've heard from a lot of our guests is not all of these buildings are created equal. And
absolutely.
Class A is doing really well.
Yep.
But then you have a lot of laggards, and vacancies are in those places.
Right.
And then there's also the AI question, of course.
Absolutely,
yeah,
the AI scare. And we spoke about that because, of course, CBRE is one of the real estate services companies that was caught up in that February sell-off, the broad-based sell-off where everyone felt as though maybe artificial intelligence could make some of these industries obsolete. So, as I mentioned before, they don't really like to focus as much on the brokerage side of the business, but that is also an investor concern as to whether or not artificial intelligence could potentially, present a threat to their business model.
All right, really interesting stuff. Great interview, really important company. And if you missed any of it, the full interview you can probably find on the Bloomberg and at Bloomberg.com. So be sure to check it out. Bloomberg TV Markets correspondent Norah Mulinda, who caught up with the chairman and CEO of CBRE, Bob Sulentic.
Hey, when we come back in just a moment, about half of women and 20% of men over 50, they break a bone because of osteoporosis, yet many people with the condition do not get treated.
Yeah, we're going to dig into that story, a reality as we all get older. We'll get to that when we come back. First up, though, a check on the markets once again. We're definitely off our worst levels of the session, Charlie Pellet.
Indeed, and let me put that all in context, put some numbers on it, Carol Massar. At the worst level of the day, we did have the S&P 500 index down 1.3%, down 91, right right now. Going to the numbers, S&P stands at 7112, lower now by just about 25 points. That is a drop of 0.4%. Dow Industrials down 178, a decline right now of 0.4%. Nasdaq down 195 for Nasdaq, a drop there of 1.8%. A flare-up in tensions over the Strait of Hormuz, sending stocks lower. Oil is rising on concern that a prolonged closure of the waterway could worsen energy disruptions. The VIX just above 19 right now, with a 10-year that's currently yielding 4.31%. Spot gold down $27 the ounce, down 0.6%. Crude 96.01 a barrel, talking WTI up 3.3%. Brent 105.22 up by 3.2%. Briefly after earnings, Tesla down 3.3%. After earnings, Texas Instruments up 18%. Intel reports after the bell up now by 3.5%. And that, my friends, is a Bloomberg Business Flash.
All right, Charlie, thank you so much. That, of course, is Charlie Pellet with an update on the trade. We'll head back to Charlie in just a moment. Tim mentioned this. I'm going to go back there. About half of women and 20% of men over 50 break a bone because of osteoporosis. Yet many people with the condition don't get treated. But late last year, we did see the Food and Drug Administration making an important policy change that is expected to spark new interest in treating the common bone disease.
So instead of waiting years to see whether clinical trial participants experience fewer fractures, drug makers can now measure whether their medicine increases bone mineral density. It'll make clinical trials much shorter and cheaper, but it's expected to entice more biotech companies to pursue new drugs and investors to back them.
And it'll be interesting about the differences men versus women, because we know we've talked about that a lot in this segment. Let's get to it. It's time for the Business Week Women's Health segment. We focus on key issues in developing technologies impacting the present and future of women's health around the world. Delighted to have with us Dr. Doug Lucas. He's an orthopedic surgeon, osteoporosis specialist at the telehealth platform LifeMD, joining us here in studio. Welcome, welcome.
Thank you. Happy to be here.
It's good to have you here. I don't think we talk about it a lot, but I think we should. Tell us about this condition and why you chose to focus on it, especially when it comes to health, bone health in women.
Well, I mean, first of all, thank you for letting me talk about it, because you're right, we don't talk about it enough. Osteoporosis, as you mentioned, has a very high morbidity rate, meaning the problems that come along with fracture is very high, meaning you could potentially die after a fracture. A third of women and men after a fracture will actually pass away within 12 months. The loss of...
Why is that? Wow. So, because you sound like people get fractures and they deal with it. Why?
So a lot of it has to do with who is actually having fractures. Some of these patients are older, they're very frail to begin with, but we're actually seeing fractures younger and younger too. And so while the mortality, the death rate is very high and alarming, it's actually the loss of independence that I think is more important. And not that death isn't important, but we see so many women especially lose independence much earlier in life than we would anticipate, and it catches them off guard because we're not talking about it and we're not screening.
Well, I feel like orthopedic surgeons, you often see an orthopedic surgeon for the first time when you've already had an injury. Right. You know, you're going in because you need something fixed. And that doesn't sound like we're prepping in the right way or avoiding this in the right way. So what should we be understanding? What should we be talking about? What should we be doing to actually prevent having to go see you?
So there's two huge things here. No, it's fine. I actually don't operate anymore because I actually am now in the game of prevention. I want to educate. I want to prevent. And so there's two main things to think about here. One is screening. So screening earlier. Right now, the recommendations from some of the governing bodies like the USPSTF, United States Preventive Services Task Force, recommend screening for women at 65 and men for 70 if they have risk factors.
That seems old.
It is way too late. And I understand they do it because of the statistics, and I get it. But we should be screening, especially women through midlife, perimenopause, and menopause, because that is the opportune time to intervene, especially when we talk about hormone therapy.
Well, let's go there, because I feel like in the last year or so, we've had a whole kind of enlightenment about some of the research that's been done when it comes to women and hormonal therapy. So what have we learned, and what do we need to know now going forward?
Well, this is a really fun space for me to talk about, because this is where we get to talk about hormones in a different light. For the last 20 plus years, we've been living in this sort of fear, use as little hormone as possible, only treating symptoms. Those are what the guidelines actually still say for the most part, is treat symptoms of menopause. But when you look at hormones through the lens of bone health, we have the opportunity to start saying, wait a minute, the lowest dose that treats your symptoms might not actually be enough to treat your bones, to prevent bone loss. And yet estradiol estrogen, is FDA approved for the prevention of osteoporosis. But if we're not measuring it, then we don't actually know that it's doing what we want it to do. And this is where we have to get into a new space of hormone optimization rather than just hormone replacement or menopausal hormone therapy.
What happens to people who've missed that window? I think about, this is where, okay, every day we're learning how to treat various ailments across the spectrum, if you will. So what happens for those who've missed out? And obviously we're getting enlightened about for the next generation, if you will.
Sure. There's a lot of opportunity to talk to different groups of women here. For the women that went through menopause over the last 20 plus years, many of them are traditionally, quote unquote, beyond the window of opportunity, which is within 10 years from menopause, right? I talk to a lot of these women in their 60s and 70s every day, and they are angry that they didn't have that conversation, that opportunity was robbed from them. But at the same time, the research actually supports there is opportunity for some of these women, especially the women 10 to 20 years from menopause. So this is most women in their 60s. It's not necessarily too late. We just need to take individual risk factors into consideration. A lot of doctors, unfortunately, are still treating as if any time after 10 years out from menopause is too late.
That's what I feel like. As a woman, as the mother of a daughter, it is fascinating to see I have a 23-year-old daughter, going into various medical offices and how they're treated, how we're treated. It's not always so ideal in terms of being open to what you say about yourself or the questioning of, well, maybe that's, not kind of really thinking about the diagnosis and maybe pursuing what's wrong.
I think you're saying it nicely.
We're trying to be careful here, but you know what I'm saying.
Absolutely. No, absolutely. It's
really, why is that still?
I think there's a lot of reasons. I think for most of modern medical history, we have not treated women as individual. Women are different than men.
Yeah.
The sexes are different. Women have different needs than men's, and the research shows that. Research has mostly been done on men until very recently. There's very little funding for women in medical research, even currently.
Amazing.
And so doctors, I think for the most part, mean well. They want to treat their patients, but a lot of times they don't actually have the tools they need or the knowledge they need to treat a woman as a woman, which is really unfortunate. On top of that, there is this underlying just paternalistic nature of physicians that when it comes to women, we tend to tell them what to do versus when it comes to men, we tend to educate them on the risks and let them decide.
Is this being taught in med school these days at all?
Which part?
What you just mentioned, what we've tended to do and what physicians have tended to do. and ways to avoid that bias when it comes to treatment.
Not in my medical school training. No, we do learn from our mentors, though, right?
Yeah.
So these are how things get passed along from generation to generation in medicine. This is how these biases get passed down.
Real quickly, got about 40 seconds. I'm going to go 3 things. Calcium and vitamin D, important?
Yes, but it's just one part of the bigger picture.
Doing weights.
Absolutely important.
What's the other part of the picture that people should be thinking about here?
Get screened early, optimize hormones, resistance training, and impact if you can do it. That's the recipe. And food.
Peptides?
Eat a whole food diet.
Peptides?
That's a longer conversation. The answer is maybe. There's a lot of research coming, though.
Okay. Will you come back?
Absolutely.
All right. That would be great. So appreciate it. That, of course, is Dr. Doug Lucas, orthopedic surgeon, osteoporosis specialist. Say that 5 times fast. At the telehealth platform. It is, of course, LifeMD.
When we come back, we are talking stocks on a move on a day when we are seeing stocks lower today. The S&P 500 off of session lows, but still down 0.5%.